I assume that most of you are very familiar with gold and silver in various formats, ETFs, bullion, maybe even futures. Today we're going to talk about trading gold and silver futures, but then hedging your price risk with options. Now, there's many ways to do this. You can buy options, you can sell options, you can do both. Today we're going to focus on selling options against a long futures contract. And hopefully from there you can, in your own practice, maybe take it a step further, but I'll give you some ideas and we'll see where it goes. My name is Carly Garner. I'm a futures and options broker. I'm located in Las Vegas, Nevada. If you have any questions or comments, concerns, this is my contact information. We'd love to hear from you. And if you're on social media, check us out. I try to post notifications of events like this, the one that we're doing today. So webinars, charts, commentary, memes, things like that related to trading. I also post dog pictures. If you're not an animal lover, you may not like my Instagram page. This is my dog Frankie, and this picture doesn't look like a big deal, but it's a huge deal because it occurred right after the Las Vegas Strip was shut down for COVID. On a normal day, you'd have to wait 2 hours to get this picture, and I walked right up and took my picture. I'm a broker, as I had already mentioned, a strategist. Our clients do receive trading ideas. Most of them are option related. A lot of them are similar to what you're going to see today. I'm also an author. I've written a couple of books. We'll talk about those soon. I write a column for Stocks and Commodities magazine, contribute content to Mad Money as well as Options Insight. So I'm not perfect. I don't have a crystal ball, but I've been doing this a little while and I've seen a lot of things. So my goal is hopefully to take some of the lessons that I've learned, some of them extremely tough lessons, and help show other people how to possibly avoid that or mitigate the pain if you do undergo those sort of things. If you look me up on Amazon, you'll see I've written 7 or 8 books. Don't worry about the others. These are the only ones that you need to look for. Everything else is out of date, printed by other publishers. Those are the newest, and honestly, I've basically took all the information, made it bigger and better, and put it in those 3 books. So don't worry about anything else. Okay, let's get started. Start talking about all the good stuff here. There's a substantial risk of loss in trading futures and options. It's not for everybody. It's not for most people, I like to say. And particularly precious metals. When we're talking about gold and silver, we've all seen it, we've all experienced it. They are treacherous markets. When it's good, it's great. When it's bad, it's awful, right? That's just the nature of the beast. Gold and silver are not for the faint of heart. Now, if you're not familiar with futures, I'm going to talk a little bit about futures and explain to you why maybe it's worth considering. I know a lot of gold buyers and gold bugs, if you will, like to be able to touch the asset, to feel it. They like to know that it exists. And I get that, but it's not unlike anything else in our lives. Remember, we used to have books that we flipped pages, and now most people are reading things online or using a Kindle. So times change, and maybe you should think about metals differently as well. In the futures markets, you have 23-hour market access. So you can buy or sell at almost any time of the day. The market does pause for an hour each afternoon, but to be honest, there's really nothing going on then anyways. Strategic purposes, the exchange picks the slowest time of the day to pause trading, regroup, so on and so forth. So almost around the clock, you can buy or sell. It's extremely liquid. Tight bid asks. So if you're buying or selling gold in the futures market, the bid and ask are usually about a tick apart, sometimes 2 tick, big deal. That's $10, that's $20, and you can literally get in and out a million times a day. If you wanted to, I'm not saying you should, but without a whole lot of slippage for the most part, unless there's something really weird going on. You can't really say that for the bullion market or the cash market. If you're trying to actually buy or sell physical gold, the bid-ask spread's really, really wide. Not a few dollars, hundreds or thousands of dollars. So there's a big liquidity difference. Also, the futures markets, you don't have to pay for storage or delivery costs. If you want to be long 100 ounces of gold, you buy a futures contract, you own it. That futures contract represents 100 ounces of gold. So you are trading paper in a sense, but it's backed by actual gold. So it's not fake or fiat or anything like that. There's no counterparty risk. The exchange guarantees each transaction. So if you buy gold at 1800 and you sell it at 2000, I mean, we all wish we could do that, right? But let's say you do that, and regardless of who's on the other side of that trade, If that person can or can't live up to their obligation, you don't care. The exchange guarantees your trade, you're good to go. You make your money and you can take it almost immediately. Sounds like something that should be obvious, but getting in and out that easily and taking your money is not necessarily a guarantee if you're dealing off exchange, if you're dealing in unregulated markets, if you're dealing with bullion. It's just simply not that easy. So again, I'm not telling you to abandon anything you've ever known about metals. I'm just saying maybe think about some other things, just like you've taken your reading to Kindle. Maybe you should take your metals online as well. Futures markets are also more efficient than ETFs, so most people kind of flock towards convenient. And I realized that ETFs such as GLD are very convenient because most people already have a stock account open, they have access, they can get in relatively quickly. However, it's not as tax efficient if you're using an ETF, and there's also rebalancing and administrative costs. There's VIG in there. It's just not as efficient as the futures market. Also, on the futures side of thing, there is potential for hedges. And that's what we're going to focus on today. So this is just to give you an idea, and we all know this, but just a reminder, gold can be extremely volatile. Most of the time, really large rallies are followed by really big corrections. Most big corrections in gold are 25 to 40%. To put current action in perspective, we've seen gold correct less than 20% from last year's highs. So while it feels like we're literally have completely melted down in gold, the reality is this correction isn't as big as what we might normally see in gold. Also, in 2011, when gold peaked out around $2,000, about a year later, after waffling around and trading sideways, about a year later, really melted down and ended up eventually getting to 1200 within a handful of months, and we actually got all the way down to 1050 a few years later. While it feels like there's buyers on every dip in gold, we've seen this movie before. I'm not saying gold's going back to $1,000 an ounce. I'm not saying that. I'm just saying we need to be aware of what's happened in gold previously and hedge accordingly. Make sure if you're trading gold, you have some hedges in. That's all I'm saying. We saw a big flash crash a couple of weeks ago in gold, and there appears to be some sort of a stick safe. If you're a hockey fan, you know what I'm talking about. The market crashed on a Sunday night open, and it bounced back pretty sharply by the following Monday morning. And of course, we've kind of waffled around a little bit, but the path of least resistance has been higher since then. We've regained almost all of that flash crash. With that said, again, we saw this in 2011, 2012, so let's not be complacent. There are some really good opportunities for hedging. Now, keep in mind, hedging is a lot like insurance. When you buy insurance or when you hedge, it means you're removing price risk, right? You're taking price risk away from you and pushing it to someone else. What it also means is there's a cost to that. Insurance is never free. We know that. Hedging always means you're giving something up. There's an opportunity cost. So in this situation, we're going to talk about selling options against our futures positions. That means we're giving up unlimited gains. In exchange for a little more comfort, maybe a little more sleep at night, we're giving up the theory of unlimited gains. And I think we all agree that gold's had some really big runs historically, but for the most part, gold trades sideways or maybe even quietly lower. So giving up the upside potential occasionally is going to be really frustrating, but on average, it's going to be the right thing to do. So the biggest issue that people have with using investment dollars for metals, whether it's gold or silver, is metals don't generate income. They don't generate dividends. Gold doesn't pay a dividend. Some people say, but what about the miners? And that's true. I'm not a stock expert, so talk to your stockbroker about that. But I mean, there's definitely company-specific and industry-specific risks that the miners are subjected to that the gold itself, the actual physical metal, is not. So if you're buying gold miners or silver miners, you're not necessarily buying gold, you're buying obviously the miner. And so there's other issues to worry about. So again, if you want an efficient way to buy gold, the futures market might be the way to do it. And then if you sell options against it, you're kind of creating a dividend. You're basically creating income that mimics a dividend. The reason you would want to do this is to smooth out your account balance. For example, today, gold was down $20 on the low. If you were short a near the money call option against that coming into the day, instead of losing $2,000, you might have lost $1,000. So it's a little more comfortable. Your account balance is going to swing as dramatically, and hopefully as a result, you make better trading decisions. Hedging futures with options, specifically today, we're talking about covered calls. What is a covered call? Most of you have probably heard of covered calls in stocks. Trading covered calls is a very popular strategy among stock traders because it's considered lower risk, it generates income, it provides a risk buffer against a lower stock price. So, for example, if you're long a stock and you sell a call against it, any premium that you collect can basically be used to buffer your downside risk, and you get paid to wait. You can do the same thing with commodities. However, if you're going to do it in commodities, you're going to want to modify the strategy. So, just to clarify, a covered call strategy is one in which a trader purchases an asset and then sells a call option against it. That call option brings in premium. That premium hedges the trader on the downside. It offers a risk buffer. Now, it also caps the profit potential. If the market goes above the strike price of the short call option, the trader really doesn't benefit at expiration. He still gets to keep the premium, but as the market is moving higher, the losses on the short call option are offsetting gains on the futures and vice versa, and they wipe each other out. So you get to keep the premium anyway, but you're not benefiting as the market's going higher. So that's something to keep in mind. If you're talking about covered calls in stock, generally traders are doing a one-to-one basis, meaning if they buy 100 shares of stock, they're going to sell one option, which is 100 shares. In commodities, I don't think that's going to work quite as well as traders intend. So I would suggest modifying it. Due to the leverage in commodities, just a real quick demonstration on what leverage is. If you're trading gold futures, the 100-ounce contract, which is at about, we'll just say gold's at 1800. I know it's a tiny bit lower, but let's say it's at 1800. So if you're trading a 100-ounce contract, that's $180,000 worth of gold. The margin to hold that contract is, I should have looked at this before I came on, I admit, but I think it's about 15,000. It might be a little less than that, but we'll just round. So for $15,000, a trader can buy $180,000 worth of gold. Now that's really great if somebody opens with $20,000, buys one future, and gold just continually goes up without any stress. That's probably not going to happen. More often than not, you're going to see drawdowns. You may even see big drawdowns, and there may even be big volatility. So this is my opinion. I believe that you should cut down on the leverage by overfunding your account. I rarely think you should ever trade with your entire account. So for example, if you were going to open with maybe 50 to 100,000, one contract of gold would probably be reasonable because you're still getting leverage, but you're not getting so much leverage that you're going to blow out your account in a week or a day. Nobody wants that. The bottom line is futures traders are working on leverage for the most part. The reason that matters is you have to collect enough premium to make the strategy worthwhile. Because remember, if you're selling an option, you're limiting your profit potential. If you're limiting your profit potential, but you're only collecting a couple $100, it just simply isn't worth it. That couple $100 isn't going to give you much of a risk buffer. In a futures contract, if gold drops $2, that's $200. So you can see that $200 is literally meaningless. If gold drops $100 like it did a couple of weeks ago, that $200 versus $10,000 in futures losses means nothing. So you have to make sure if you're going to sell an option that there's enough premium to make it worth your while. It has to actually hedge your risk. And if you're going to cap your profit potential, you still have to have a pretty hefty profit potential to accept the downside risk. So you can do this by selling an at or near the money call option and or selling a higher quantity of options than futures. So for example, I wouldn't go crazy on this, but if you're long one futures contract, you might want to sell two calls against it to bring in enough premium. We're going to go through some examples shortly, by the way. Or you could buy one futures contract and sell an at-the-money call option. And you might be wondering, why would you cap your profit potential at the money? What's the point? Well, the point is, in gold futures options, you can collect a lot of money. So even though your profit potential is capped, it's quite large. And that quite large premium that you collect gives you a very nice risk buffer. These are prices I took yesterday. This is obviously a hypothetical example, but these are yesterday afternoon. Now we know the metals sold off a little today and then recovered some of the losses into the close, but these prices aren't that far off. So as an example, a trader could buy a December silver futures contract at $24. Sorry, I'm getting my marker out. All right, so you could buy a silver futures contract at $24. Then you could sell a December silver. So notice these are the same expiration months. A December silver call option with a strike price at 24. You're probably never going to exactly buy the future at 24 and then sell the 24 strike price. You're probably going to buy the future at a couple cents lower, a couple cents higher, but you get the idea. and for math purposes, I'm going to keep it real simple. The 24 call option or the at the money call option brings in $1.30 in premium. That's $6,500. So that is $1.30 or $6,500 that the futures trader can use to buffer his downside risk. I'm going to show you a chart in a minute so you know exactly what I'm talking about. The margin required on a position like this is 12,634. Don't ask me why the exchange does it down to the dollar like that. I mean, 12.6 would have been fine, or 12.7. I don't think anyone would have complained, but they do it exactly to the dollar. So that's what it is. $12,634 for the strategy. If you just bought the futures outright, the margin would have been $14,850. So you get a little bit of a margin break. You don't get a ton of a huge break because the exchange knows the most you can make is $1.30. And if the market drops very sharply, more than $1.30, you're naked basically under that level. So you still have theoretically unlimited risk on a futures contract, or at least down to zero. The exchange knows that, but it also knows that this is going to be a little smoother than just simply buying a futures contract outright. So there is no cash outlay because you're collecting $6,500. So the exchange or the market is giving you $6,500 to wager this bet. And as a trader, what you want to happen is you want silver to be at $24 or higher at expiration. So you don't have to be right, you just have to not be wrong to keep the entire $6,500. If at expiration we're at 24.01, you make $6,500. If we're at 29.01, $5 higher, you still only made $6,500. But you can see where I'm going here. You really don't even have to be right. You just have to not be wrong. And you have to hold all the way to expiration, which is harder than it sounds. So keep in mind the math that we're talking about is at expiration. And I'm going to give you some hints as to what might happen before expiration as we go through this. So the most you could make is $6,500. Your risk is theoretically unlimited below 2270. That's because you basically run out of your risk buffer at 2270. You bought at 24. From 24 to 2270, you're eating up the premium that you collected. Underneath 2270, you're just naked. It's like not having a hedge at all. Now, I'm telling you these figures at expiration. Before expiration, it's a little bit different. Before expiration, this option isn't going to lose penny for penny as the futures market declines. So let's say the futures market gets to 2270, but there's still a month left to expiration on the option. That option will not have lost all of its value. It's probably still going to be worth 30 cents is my guess. There's no way to predict what it'll be worth because it's based on time, volatility, and demand. So I'm just guessing. But based on my experience, that's probably what you'd be looking at. Even though your break-even point is 2270 at expiration, if that option's still worth 30 cents, you're actually not breaking even. You're losing 30 cents at any time before expiration, assuming those prices all work out, which is like $1,500, just so you know. Okay, so this is if a trader went long at 24 and then sold the 24 call, which is right here, he breaks even at 2270 at expiration. And you can see this isn't a coincidence that that level is below support. So of course there's no guarantees in a trade, but this is a pretty high probability setup, right? The odds of the market being below significant support at expiration aren't necessarily high. Could happen, but it's not necessarily likely. The most likely scenario, in my opinion, and according to this chart, the market's been spending most of its time above 24. So this trader makes his entire premium collected, which again is $6,500 or $1.30 in premium, if silver is anywhere up here. Now it will be a little sad if silver's at 29 because you'd be leaving thousands and thousands of dollars on the table doing that, assuming silver was at 29. But let's be real. Most people don't have the wherewithal mentally or financially to hold on to a move that long. And so the odds of them actually cashing out at 29 probably aren't that great. And keep in mind, you can add on or adjust. You don't have to just put the trade on and hang on to expiration and never touch it again. Let's take a look at what this might look like in a different market, in gold. Okay, so gold is probably a little better of a market for this type of a strategy, just simply because it's not quite as herky-jerky, not quite as volatile. Things are a little smoother. It's not as stressful. And I think you can still get some really good premium for the risk. Again, these are yesterday's prices. Buy the December futures contract at 1800. Sell a December gold. Again, the same. They don't have to be the same expirations, but make sure the option that you sell trades against the same future. So if you're looking at gold, if you sold an October option, the October option trades against the October future. It would still work out okay, but it wouldn't be a perfect hedge like you're intending it to be. So just make sure you're selling an option that trades against that particular futures contract. So in this situation, you could have collected $55 or $5,500, and the margin on it this trade is 7,010, and I lied. The futures market on one contract of gold is not a little over 9,000. If you've bought the futures outright, you'd need $9,000 in margin to hold $180,000 worth of gold. You can see how people get into trouble pretty quickly. And honestly, because there's so much leverage built into the market, that's exactly why you see the crazy things you see like a few weeks ago with the flash crash. People don't have the money to just ride things out, so they get forced out. They get margin calls, they get stopped out, so on and so forth, and it just flushes things out. If gold is at 1,800 or higher in 91 days and you hold all the way to expiration, again, that's not easy. And I probably wouldn't recommend you do it, but this is just for educational purposes so you have an understanding of what the strategy is like. You pick up 5,500 if you're just not wrong in gold. Now, keep in mind, your risk is unlimited under 1745, meaning you run out of your risk buffer at 1745. I mentioned that before expiration, the math isn't going to work out like this, and it's not. On an extremely volatile day, you might actually even find a situation where the futures is down 30 points and your option really doesn't lose much money. And that's because changes in volatility will change how the option behaves. But don't get discouraged, because if you continue to hold as time goes on, that'll all work itself out. Sometimes markets panic, just like futures markets panic and flush everybody out. Option markets sometimes do the same thing. So you always want to make sure that if you're doing these types of strategies, you have a lot of room for error. That means a well-funded account. You should really only be using about 20% of your account towards margin, to be honest. So this is what that trade would look like in gold. Going long December 1,800, selling an 1,800 call. Again, you make money as long as the gold's above 1,800. So you only have to be right by a penny or a dime, and you make the entire $5,500. Your risk is unlimited down here. If it breaks below your break-even point, again, gold hasn't spent that much time down here. Could it happen? Sure, anything can happen. But if you're a gold bull, I'd say that's a pretty fair trade. Let's take a look at one other thing here. So far, we've just done a simple covered call, but it doesn't have to be that way. You can go just a little step further and sell an extra call. You can be short 2 calls. Now this poses some risk on the upside. So basically you're taking away some of the downside risk, or I should say giving yourself a bigger downside risk cushion in exchange for accepting upside risk. So you want to be careful with that, obviously, especially if you're bullish. You don't want to be in a situation where you're too right. But let me show you what this might look like. So this time we're selling the 1,800 and the 1,900. We're collecting a total of $7,700. The margin is now a little bit lower, so it's 6,300 instead of 7,100. And all that has to happen is gold has to be at $1,800 or higher for you to make that $7,700. So this is a way to pay while you wait. If you're the type of person that wants to always be long gold and you're willing to ride it out for years, which has been necessary to catch the upside in gold, let's just face it, that's how this market works. This might be something you could consider. That way, if it takes a year or 2 or 3 for gold to actually pick up the pace and start moving higher, at least you're bringing in some income on the calls. Now, again, you're giving up upside profit potential, so it might eventually get frustrating if everything explodes all in one day, but this is probably a much sounder approach than simply just being long gold and hoping for the best. Of course, your risk is unlimited below your break-even point. So once you run out of the premium you collected, you have unlimited risk. And now, because we're selling 2 call options and we're only long 1 future, we can lose on the upside if gold goes above 1977. Now that's assuming you hold the expiration and you don't adjust or buy another future against it or so on and so forth. If you just sat there and did nothing and gold kept going up, you might get into trouble above the market. What I would suggest is especially if you're a bull, and if gold starts coming up here up against the short strike price of your second call, I would go long a second futures contract and control your delta. That way, if it goes up, you still get to keep all the premium you collected for both contracts, plus the futures, assuming it keeps going up. It gets a little bit hairy and stressful. If gold hits this area, you go long a second contract and it waffles around, because then you don't know if you should get out of the future or get in or whatever, but maybe you might even look to sell. At that point, you might sell a 2,000 call. So I'm not trying to confuse you. I'm just letting you know that these types of strategies are meant to be adjusted. You can change them. You don't have to just put it on and hope nothing bad happens, because you're in control. You can't control the market, but you can control you. So if you feel like gold's going to start giving you trouble up against the second call option, do something. Maybe it means buy a mini. You don't have to buy a full size contract. You can get your delta under control by buying or selling futures contracts against your options. I probably went a little too far to confuse you on that one, but the idea is if you're long the future, collect premium. That premium buffers your risk all the way down here. Again, now we're talking our risk only comes in at expiration below this area that gold has not been able to hold at all for the last couple of years. So don't just sit there, adjust your trade if you need to. If the market rallies sharply, you can buy another futures around 1900. I just mentioned that. The purpose of doing this is to maintain a net long delta. The delta is how much your position moves according to a $1 move in the underlying futures price. If gold rallies sharply and you're long one future and you're short two options, it might get to a point where you're no longer long the market, you're actually short the market. If it gets to there, you can buy a mini or a micro or maybe even a full-size contract to get you back into a delta long position. That way you know you're comfortable, you've got all this premium collected, and you're hedged on the downside. Gold sells off sharply. If it does the opposite of what you think is going to happen, buy back your calls. For example, if you were holding long gold and short calls a few weeks ago during the flash crash, you might have wanted to go in and buy all your calls back and just see what happened and then resell them if the market rebounds. Be creative. You do not have to stick with what you've got. You can change with the market. Markets change. You should change. Your strategy should change. In conclusion, precious metals should be considered a highly speculative vehicle or a portfolio diversifier. In my opinion, I think that's best done using the futures markets. I know it seems complicated because people want to just buy gold and put it in their garage or their safe or whatever it is, but it's really, really difficult. If you actually need to liquidate that gold, good luck. It's not that easy to do. In the futures markets, you have 24-hour access, well, 23-hour access. It's liquid. You can use the money almost immediately. If you had a gold holding in your futures account and you sold it today, you could wire the money out of your account tomorrow and use it to buy something. So it's really just so much more efficient. Take your gold online. No reason to hang on to the safe in the basement. And I highly encourage people to trade or hedge within your means. If you're going to buy a gold future, make sure you're only using 20 to 30% of your account towards margin. That's my advice. You can certainly use more. I consider that very good advice. And hedge. Sell premium to hedge it. If you're only comfortable selling one option against it, I get that. Go for it. Sell one, but make sure you have a risk buffer. One other strategy is you could do a one by one to start with, but if gold rallies, maybe sell another call against it while the call option is expensive. The idea is if you're collecting premium and hedging your position, you're probably going to make better decisions. And this is a mental game. The worst thing that could happen is for you to be over leveraged and run out of money, or be stressed out and run out of, basically just run out of mental capacity to handle the situation. I hope that you learned something today, maybe a little different perspective on how to trade gold or how to hedge gold. Please be sure to visit our website, decarleytrading.com. There's a lot of educational material, articles, videos, all kinds of good stuff. So if you're interested in learning, and if you like what you heard today, it's really hard to fit this kind of information in a small class like this, so I do my best. It's complicated information. It's really not as complicated as it seems. I promise you, once you do it a couple times, it's not going to seem that complicated, but in the beginning it is. That said, I go through these types of things in much more detail in my book. Tradingcommodityoptions.com is the website, or you can go to Amazon and you'll find the book. It's Trading Commodity Options. But on the website, you'll find excerpts and things like that, so you can take it for a quick spin. But we describe this strategy of covered calls, as well as other strategies, adjusting them, the purpose of them, the risk, the reward, all of that kind of stuff. And here's my contact information one more time. If there's anything that we could do for you, just let me know. I'd be happy to hear from you. And again, check us out on social media. We try to keep it fun but informational.